Welcome to the Deep Dive, where we cut through the noise to bring you the most vital insights from complex information, making you well-informed quickly. Today, we're taking a deep dive into the latest financial disclosures from Century Plyboards India Ltd. This is for the quarter ended June 30, 2025.
That's right. And we've got their unaudited financial results and a pretty detailed investor presentation to work from. Our goal here is really to pull out the key takeaways, help you understand not just the numbers, but what's really driving the company. And just a quick note for listeners, when we mention lakhs or crore, remember a lakh is 100,000 and a crore is 10 million. It's just standard financial terminology in India.
Good point. So it sounds like we're looking at a company juggling current performance with some pretty big bets on the future. Let's start with the big picture then. How did Century Plyboards actually do top line-wise in Q1?
Well, looking at the consolidated figures, revenue from operations showed pretty healthy growth. It was up 16.3% compared to last year, reaching just under, let's see, 1,017,000 lakhs.
Okay, 16.3% consolidated and standalone.
Standalone revenue, which is more the core existing business, that also grew. It was up 6.8% year over year, hitting over 1,700 lakhs. Management actually pointed to this as showing the resilience of our business model, which is, fair enough given the growth.
That is solid growth. Now, I noticed they made a point about quarter-over-quarter comparisons being less meaningful. Why is that important here? Why focus on year over year?
Right, that's a key detail. They explicitly say Q4, the previous quarter, is usually their seasonally strongest quarter. That's because they run their big annual sales schemes then. So if you compare Q1 directly to Q4, you'd naturally see a dip, and that wouldn't really reflect the underlying trend accurately.
Okay, so the year over year gives us the cleaner comparison. Makes sense.
Exactly. It avoids that seasonal distortion.
Got it. So sticking with those year over year numbers, what about profits? Did they manage to grow the bottom line too, or was it a different story there?
It's actually quite a mixed picture, and this is interesting. On a consolidated basis, yes, net profit jumped significantly. It went up to about 5,293 lakhs from roughly 3,411 lakhs in Q1 last year.
Wow, quite a jump consolidated.
It is. But on the standalone side, net profit actually saw a slight decline. It went down from around 7,390 lakhs last year to about 6,782 lakhs this quarter.
Huh. That's a really interesting divergence. What does that gap between the strong consolidated profit growth and the slight standalone dip tell us? What's happening there?
Yeah, it's telling. The consolidated results you see include everything: subsidiaries, newer ventures, like their Badville plant, which is ramping up. That big jump suggests these newer operations, the investments, are starting to really pay off and contribute positively.
Okay, so the newer stuff is boosting the overall group number.
Precisely. Whereas the standalone number, that reflects the established core business. The slight dip there, the company says, is mainly because they spent more on advertising and promotions this quarter, trying to fuel growth.
Right, investing in marketing for the core brands.
Exactly. So you got the overall group benefiting from new capacity, while the core business is facing some temporary cost pressures from those growth initiatives.
That puts it in perspective. Okay, what about EBITDA? That operational profitability measure, how did that shape up, both consolidated and standalone?
Sure. Consolidated EBITDA, if we exclude the Forex impact, that improved. It went up to 12.5% this quarter from 11.2% in Q1 last year. And again, management points to the Badville plant contributing positively here since it was just starting up last year.
So Badville is a recurring theme for the consolidated strength.
Definitely seems to be a key driver. Now, for the standalone EBITDA, again excluding Forex, it was 12.7%. It's actually a small dip from 13.5% last year. And, like the net profit, they attribute this primarily to those higher advertising and promotional spends in the core business.
Okay, consistent story there. And for investors looking at their individual holdings, what happened with earnings per share, the EPS?
It mirrors the profit trends, as you'd expect. Consolidated EPS, basic and diluted, increased to 2.33 from 1.55. But following the standalone profit, the standalone EPS declined a bit to 3.05 from 3.33 last year.
Right. Again, highlighting that dynamic between the whole group benefiting from expansion while the core standalone felt the pinch from investment spending.
Exactly.
Okay, we've got a good handle on the overall financials now. Let's peel back the layers a bit. This is where it gets really interesting. How did the different product segments perform? Which ones were the stars and which faced challenges?
Absolutely. And the reports give us some good color here.
Let's start with plywood. That's kind of their bread and butter, right? How did it do?
Plywood is still looking very strong. Standalone top line grew 15.3% year-over-year, which is impressive. And importantly, volume was up too, by about 9.8% year-over-year. The standalone EBITDA margin, before Forex and any unusual items, was a solid 13.8%.
13.8%. That's quite healthy.
It is. They actually highlight, it puts them among the best performers in the industry. So, yeah, core plywood seems to be doing well.
Okay, good news there. What about MDF, medium density fiber board? That's a segment lots of people are watching for growth potential.
And they're seeing it. MDF performed very strongly. On a consolidated basis, revenue was up, get this, 23.7% year-over-year.
Wow, nearly 24%.
Yeah, significant growth.
Yeah.
And the consolidated EBITDA margin, excluding Forex, came in at 14.3%. They again mentioned this is one of the highest in the industry, and they link it directly to using their capacity better, especially at that Badville plant, and getting costs under control there.
So Badville is really boosting the MDF numbers specifically then.
Clearly. It looks like a successful ramp-up story so far for MDF.
Okay, what about laminates? Has that segment shown any improvement? I know it's faced some pressure.
It has, and there are some positive signs. Management says it's starting to show signs of a turnaround. Consolidated revenue grew 12.8% year-over-year, and importantly, it also grew quarter-over-quarter by about 1.9%, suggesting some momentum. The consolidated EBITDA margin was 5.9% without Forex. They expect this gradual recovery to continue, so cautiously optimistic there.
Okay, gradual recovery in laminates. And finally, particle board. How's that segment looking?
Particle board is described as being in a recovery phase, so still working through things. Revenue was actually down compared to Q1 last year, though it did improve slightly compared to Q4. But the main issue seems to be margins. They explicitly state margins remain under pressure.
Why is that?
They cite two key reasons. Elevated timber costs. So input costs are high and pricing challenges in the market suggest it's a tough competitive environment for particle board right now.
Okay, so particle board is definitely facing some headwinds still. That segment breakdown really helps clarify the overall picture. Now let's zoom out again slightly. Connect this performance to the company's overall financial health. What about debt? How is that looking?
Well, total debt on a standalone basis has ticked up a bit. It went from about 641 crore at the end of FY25 to around 685 crore at the end of Q1 FY26.
Okay, a slight increase. How does that translate into their leverage ratios, like debt to EBITDA?
That increase in debt means the total debt-EBITDA ratio also increased slightly, from 1.4 in FY25 to 1.49 in Q1 FY26. For listeners, this ratio basically shows how many years of operating earnings it would take to pay off all the debt. So a slight increase suggests a little more leverage.
Right. And what about those key profitability ratios we look at, like return on equity and return on capital employed, ROAE and ROAC? How were they impacted?
Both of those, on a standalone basis, did decline. ROE fell to just under 12.6% from about 14.8% in FY25. And ROAC dropped to 14.3% from around 16.3%.
Okay, those are noticeable drops. But you mentioned context earlier. Is there a reason for this beyond just lower profit?
Yes, and the company is very clear about this. They state these ratios are adversely impacted due to deployment of funds in ongoing CapEx projects.
Right.
Essentially, they're spending a lot on building new facilities like those big greenfield projects, and that capital is tied up but isn't generating profit yet.
Ah, so it's the investment drag again. Money spent, but the returns haven't fully kicked in.
Exactly. It's a classic investment phase dynamic. Short-term ratios take a hit while you build for the long term.
Understood. What about managing their day-to-day cash, the working capital situation?
Actually, there's some good news there. The cash conversion cycle on a standalone basis improved. It decreased to about 71 days from 76 days in FY25. That basically means they're getting faster at turning inventory and sales into actual cash in the bank, which shows better operational efficiency.
That is a positive sign. Now, you mentioned those big CapEx projects impacting ratios. Can you give us a sense of just how big these investments are?
Oh, they're substantial. For example, that MDF Greenfield project in Andhra Pradesh. The initial budget was 600 crore. The investor presentation shows they've already spent 730 crore on it.
Wow, over budget already.
Seems so. And the particle board Greenfield project down in Chennai, budgeted at 550 crore, and expenditure noted as almost 694 crore. So yeah, these are massive, multi-hundred crore investments aimed at significantly boosting their future production capacity. They're not small tweaks.
Definitely sounds like a company playing the long game, investing heavily now. So, looking ahead, what does management expect for the rest of this financial year, FY26? Did they give specific guidance?
They did. They provided targets for each segment, which gives us a pretty clear view of their
Okay,
expectations.
let's run through them. Plywood first, the core business.
For plywood, they're targeting sales growth of 10% or more, so continued solid growth. And they expect the EBITDA margin to stay healthy, somewhere between 12% and 14%.
Right, sounds like confidence in maintaining performance there. What about laminates, the one showing signs of turnaround?
For laminates, the consolidated sales growth target is ambitious 20%. That suggests they really expect that recovery to gain steam. Margin-wise, they're aiming for 8% to 10% EBITDA standalone and hoping to hit high single-digit consolidated EBITDA by year-end.
Okay, optimistic on laminates? And MDF, the current star performer.
They expect MDF to keep shining. Consolidated sales growth target is another 20%, and they're guiding for a 15% consolidated EBITDA margin, calling it a steady-state margin.
15% steady state, that's strong.
Very strong, reinforces its position as a key profit engine.
And finally, particle board, the one facing headwinds.
This one's interesting. The sales growth target is the highest at 40%, but remember it's off a lower base. However, the EBITDA target reflects those ongoing challenges they're guiding only for low single-digit margins. So volume recovery, yes, but margin pressure likely to continue for a while.
Got it. High volume growth expected, but profitability still squeezed. That guidance really lays out their priorities and challenges clearly. So we've really dug into Century Plyboards' Q1 results here. It's definitely a nuanced story, isn't it? We've seen that strong consolidated revenue growth, really powered by plywood and especially that booming MDF segment. But balanced against that are these major strategic investments impacting the current standalone profitability ratios.
Absolutely. The narrative is very much about balancing today's operations with tomorrow's growth.
Right.
You see it in the difference between the standalone and consolidated numbers, and you see it in the segment performance strong areas like MDF versus challenges like particle board margins. It's a company in transition, investing heavily.
So for you, our listener, here's something to think about as we wrap up. Century Plyboards is making these huge long-term capital bets. While they're impacting profitability metrics right now, how might these investments fundamentally change their position in the market once these massive new plants are fully up and running? What is that trade-off, sacrificing some short-term ratio performance for potentially much larger scale and dominance later? What does that really mean for how you value a company like this? Something to definitely mull over.